Hello, everybody. This is Elihu.
And this is Peter.
And you're listening to Pineapple Chunks.
And today we're going to be talking about some of the indicators you should be paying attention to help you make better investment decisions, like inflation and modern monetary theory, Keynesian economics.
We're also going to talk about Bitcoin and how this all relates. We saw some pretty crazy price action from it recently, so we're not going to ignore it. And we're going to touch up on the 59 Americans that make up more wealth than half of the country.
It's quite a serious topic.
Yeah. A lot has been going on, and, at the end of the day, we are not financial advisors
or lawyers or attorneys.
So don't listen to anything we say. You will lose money.
Yeah, you will definitely lose money.
All right, let's get right into it.
Let's do it.
Cool.
All right. So I think, 59 Americans make up half of America's wealth. Like, that's wild. According to the recent data from the Fed, obviously it shows Jeff Bezos' face, but it should have, this is from October 8th, 2020. Now
so much has happened. Now we have a new kid in the block.
Yeah, Elon Musk is like the new guy. To be fair, if it wasn't for his divorce, like you've said many times, he would still be the richest man.
Yeah, Jeff Bezos is up in his empire, just saying, I'd still be the richest. How do you think he feels? You think he's butthurt? I would be pretty butthurt.
I'm sure in some way his ego is fraught with some envy.
The remaining hair that was on his scalp is definitely fallen off by now.
But that being said, so the poorest, I don't like that word, but let's say the poorest 50% of Americans,
the least wealthy,
or roughly 165 million people, collectively owned about $2.8 trillion in wealth in the second quarter of 2020.
This kind of makes sense because if you look at the S&P 500, which is an index of the 500 most successful companies in the United States, half of those companies, or that half of that market share, is owned by like 6 or 7 companies, and they're like the big tech.
Yeah. Like the 5 top companies make up like more than 20% of the index by market cap.
Right, and the people involved with those companies, are part of this 59 wealthiest Americans in the United States.
Right, and so we just mentioned that collectively 165 million people, which is the unfortunate 50% of Americans, collectively own 2.8 trillion, but that is still less than the nation's 59 richest billionaires, who have a combined fortune, according to the Fed, of 2.9 trillion. And this is from actually, it's not the Fed, it's the Bloomberg's Billionaires Index.
It's like such a crazy thought. It's like if you're in a cafeteria, like a high school cafeteria, and 59 kids are on this massive space in the cafeteria, and then the rest of us are just in the corner eating like.
Oh wow, this is the list. Elon Musk, 194 billion. Jeff Bezos, Bill Gates, Bernard Arnault, Mark Zuckerberg, Warren Buffett, Larry Page. Wow, that's wild.
I just said Larry David.
Who's the 59? Just want to know. Go Sheng Liang. I think I said that correctly. Probably not. But moving on to a little bit more of the indicators on things that help you make better informed decisions are inflation and also the yields on 10 to 20-year treasury bonds. And if you don't understand this very much, here's Elihu to impart some of that knowledge.
So inflation happens when a lot of money or government spending just enters into the non-government side of our system, and it's all been just printed mainly to support Americans. We're seeing stimulus checks, and all that money leads to inflation because now that there's more money in the playing field,
people are spending more,
and
that jacks up prices in a sense because there's more demand.
Right? You need, there's still the same amount of supply. So a good indicator for markets is when we start seeing inflation rates increase, and then the treasury bond rates are
Yes, the
also
yield on the treasury bond, which is basically another word of saying the profit or the amount of money you'll get paid out each year for holding this bond.
right. Those are good indicators because that means that the government is trying to get you out of the stock market and into bonds because they're going to offer slightly better returns.
And it's safer because it's the U.S. government who's paying you, or the U.S. Treasury or the Fed. In a sense, they're not one entity, but they kind of play in such a way that there's a lot of security. So when you get a raise in interest rates, that is also a raise in the profits that you receive on holding these bonds. But right now, we are dealing with record low interest rates. And that reflects on the yield that you receive on bonds, but also the amount that it costs somebody to borrow money, say for buying a house. And that's why you're seeing interest rates for buying a house or borrowing money for mortgages go down at the same time.
Right. And so treasury bond rates are synergistic to the rate of inflation. So the more inflation there is, the higher
or the lower the yield.
The lower the yield, the more inflation. The lower the yield, the more inflation, and as an effect of high inflation, the higher the yields in treasury bonds.
Well, typically it's not so naturally occurring. It takes the Fed, typically the entity involved in handling monetary policy. It takes the Fed to kind of come in and decide whether they should raise interest rates to slow the rate of inflation. Now, right now, let's see inflation, Fed, and we'll pull that up, just the rate of inflation, but we're around like 2.5%.
Which is not bad, considering...
Oh, I'm sorry, I think it's 1.5. Let me just pull it up.
Even better, which is not bad considering how it's stayed pretty consistent, considering a lot of the money that has already entered the market or the non-government side of the system. So,
yeah, 1.2% as of November.
1.2. That's not bad.
Yeah, not bad. I mean, they wanted to be at 2.5. It just means that, like, you can see here, it just means that people, they stopped spending a ton of money during April, during the beginning of the pandemic, and then they started spending more and more, and that started raising inflation, bidding up prices and whatever.
Yeah, so, like, I mean, if more people want Gucci flip-flops, then the price of Gucci flip-flops are going to increase because, I mean, not only is there more money in the markets because of the stimulus checks, I mean, I don't know where your $600 are going, but mine are going to Gucci flip-flops. But, the government isn't raising interest rates until 2022, so that's going to affect inflation even more.
Well, Kathy Wood, interestingly enough, one of the CEOs and chief investment officers of ARK Invest, a very prominent hedge fund that has gained much attention from the media and also juicy returns from its investment in Tesla and other innovative companies in the bio engineering space like CRISPR and what have you. She says that with the rate at which the government is printing and injecting money in the economy, that we're likely to see the Fed react adversely and say, hey, this is not sustainable. We're going to have to cut back on quantitative easing, which is basically buying, bad debt from banks. Just simply put, this is the basics. Don't rail on me in the comments, but it's basically it's just a very simple way of saying that the Fed might raise interest rates in order to slow the rate of inflation because, we're at 1.2. I mean, we're basically in January right now, so this is a couple months old. So we'll get the new numbers soon if they haven't come out already. But if they're above 2.5% and later on in the year, the Fed might begin to notice that it is unsustainable. Let's see what the forecast is. So the forecast is an upward sweep, as the Fed is projecting. So between 3.5% and the, 1.75, let's say, if you're looking at this in that range, they might raise interest rates, and then that makes money more expensive to borrow, but then that incentivizes like Elihu said earlier, incentivizes investors to move out of stocks and go into a safer investment like bonds, where they might be getting paid a little bit more, and it's just secure, and it's just a safer way to put your money.
And so all this that we're talking about right now is part of the Keynesian economic theory or way of handling financial matters between a government and the non-government part of a system. It's worked out pretty well up to this day, and but there's another beast in the playing field, and that is modern monetary theory.
Yes,
which is, in a nutshell, essentially the government has all the power to print its own money, and so it never goes into debt because it can never run out of money, and that is used to help the non-government part of a system. That, however, will lead to a lot of inflation, and so the government will increase taxes in order to calm down the rise of inflation. And it just keeps doing that and doing that and doing that. Well, it brings taxes back once, some recovery has happened, and then it'll keep doing that and doing that and doing that.
But really, it's just the idea of like, you can't go broke if you print your own money and you have a monopoly.
Right. And countries like the US, the United Kingdom, Japan, and Canada, they do this. They are in charge of their own monetary printing. So it's just, things are a little controlled right now, because otherwise we'd have hyperinflation like we had in, what was that country again?
In Zimbabwe, where you had 100 trillion. 100 trillion.
100 trillion.
It's crazy. I mean, look at us. We have $27 trillion in national debt. Talking about a bill that said $100 trillion. That I mean, 100 trillion Zimbabwean, whatever. It doesn't matter anymore. Well, actually, they probably bounced back, but nonetheless, modern monetary theory challenges conventional beliefs about the way the government interacts with the economy, the nature of money, the use of taxes, and the significance of budget deficits. This belief, critiques say, are a hangover from the gold standard era and are no longer accurate, useful, or necessary. So the opposing one is Keynesian economics. So Keynesian economics is basically saying the government must find ways to either disincentivize or incentivize spending depending on the way that the economy is looking, and ultimately not to print as much money. Just find creative solutions to get people to spend more or spend less. Whether if you're in an economic recession, the government will incentivize people to spend money. It will either, lower interest rates or lower taxes.
They get more creative.
A
comparison me and Peter saw was that if they were both motorists, the Keynesian economics people would worry about just keeping their motor running, while the modern monetary theory people would worry about filling up their tank
with a bunch of gas.
Yeah, right.
Like load it up. And we're not here to argue which side you're on, but it's just some stuff to maybe, if you want to look into it further, definitely research it. And there are some political things attached to each one, so we're not really into that. Our politics are green. We like the money, but if you listen to us, you will lose money. So don't listen to us. This is not financial advice. Man, it looks a little bit out of focus, doesn't it?
Just a bit.
Oh, that's a little awkward. Well.
So why modern monetary theory? Why Keynesian economics? Why any of this? Well, it's because we're starting to see a new asset class emerge.
Bitcoin.
As a safety net.
Cryptocurrency.
Sure, yeah, you can go into treasury bonds as a hedge against risk from the stock market, maybe, having less returns because of inflation, or you can go into cryptocurrency, aka Bitcoin, which has seen an amazing spike in price this past month. I mean, we got to $42,000. That is amazing.
It is quite fantastic.
Granted, it's still considered a risky asset class, but I mean, as more institutional money enters the space, the more legitimate and credible it becomes. And so the spike in Bitcoin right now, at least me and Peter believe, is a direct result of all the stimulus that we're injecting into the U.S. economy.
Right.
Because the U.S. dollar is if not it's one, or if not the strongest currency in the world. So as more money enters the markets, more U.S. dollars enter the markets, more inflation happens, the value of the U.S. dollar will decrease, and people are going to start looking for other asset classes that, won't deem their currency worthless, aka Bitcoin is one of those right now. Why? Well, there's only going to be 21 million Bitcoins in supply ever. So, I mean, if you don't know supply and demand, that's one of the...
But the beautiful thing is that no government, no one thing or entity can determine otherwise. Like, there's no way that someone can say, let's print more Bitcoin because the world is dealing with a pandemic or something, like there's no way that could ever happen. So it's a bit ruthless, but it's what is required for a currency. I mean, or for anything that is a scarce resource, say for example, like gold or real estate, there's only a certain amount, and therefore the demand, if people want it and people find use in it, then the price will go up, evidently.
So if it's just like gold, why don't people just buy gold? It's less risky. It's tangible. It's there. It's been around for years. Why are we getting into Bitcoin?
Well, tangibility is also a blessing and a curse in a sense, because we are kind of doomed to being robbed if we have a lot of gold on us and we're traveling, or even if we have it in our homes.
Oh, sorry, my pants are sagging. There's just a brick of gold in my
like
back
a bunch
pocket.
of gold on you or whatever. And with crypto, and the great thing about gold is that yes, it does. People do want it. People will take it as money, but it's just very impractical. But the thing is that people want it and it's scarce. The great thing about Bitcoin, adversely, is that more people are interested in it because of, say, the 21 million Bitcoins that are ever going to be printed, but also in its reliability to make transactions possible online without having to deal with the possibility of fraud or actually just fraud. I think fraud is a big one, where if I send you money and then you say, hey, I didn't get it, I need a refund, kind of like the age-old problem that Amazon faces with fake returns. They can't necessarily prove you're a liar without making themselves look bad, because they want to please their customers. So Amazon is willing to lose a ton of money to look good in front of their customers overall, to give their at least the honest customers a great customer experience.
Hey, I didn't get my new Xbox in the mail. It's supposed to be delivered today, but it's not on my doorstep.
And then Bitcoin and all the accountants and ledgers and the blockchain that track every transaction will call you a complete liar for saying that you didn't get your Bitcoin or your Xbox. And so there's a lot of many other use cases that can function in Bitcoin. But for those of you, I mean, if you're listening to this pod, you probably know a bit about Bitcoin, and that's probably why we could segue into something like Ethereum. Why Ethereum is so valuable. It's the same use case.
It's the second runner-up, really, in market cap and market share of cryptocurrencies, and it's unique because, I mean, well, one, it has an actual, known CEO. I don't know his name. It's a really long, intricate name.
Who wears unicorn rainbow shirts and things like that.
And it's different from Bitcoin because it focuses mainly on smart contracts, and that's a whole different podcast.
But it's the same. But it's the same thing in the idea of like a trustless system, where it's like, if we form a contract and I said, I'm selling you this piece of real estate, you can't go ahead and say I never got it. Well, it's even harder for real estate. But let's say for an Xbox, if I'm selling you an Xbox and I send you a smart contract, like, there are kind of some ways to validate that you did receive this Xbox through many different points in the supply chain, whether it be me saying that I sent it to USPS are saying that they got it, and then all these multiple different channels, basically seeing that this transaction went through.
It's a supply chain on steroids, essentially. I mean, it's going to improve
a
lot of different industries.
More importantly, it's for the online world, online kind of transactions. Now, granted, there are still some hiccups, but these the use cases are very much unique to online transactions, online contracts, because at the end of the day, people can falter and they can find a way to say, well, I got, I might have got the Xbox, but I got robbed, or there's no way of, I don't know what there is, but in a sense, but only time will tell for how efficient Ethereum can be. And also time has shown, in the past year, how efficient Bitcoin can be. Unfortunately, it did take a dip though.
Yeah.
And I see it as a buying opportunity. Don't listen to me, because you're going to lose money.
So
but
I think something that's worth noting is that this time around, at least compared to the 2017 bull run that Bitcoin had, where it got to almost 20K, this time around, we have a lot of institutional investors putting in millions, if not billions, of money into Bitcoin. It's I saw this recently. They called it business FOMO, which is the fear of missing out. Back in 2017, we just had regular FOMO, just, us regular folks FOMOing into Bitcoin, and that got it to 20K. But now we have business FOMO, where it's just a bunch of businesses and financial institutions getting in because they don't want to miss out. You have JP Morgan predicting the price of Bitcoin to go over 140K. They're not saying that because they don't have any Bitcoin. They probably have a large amount at stake. So
yeah, and psychologically thinking about it, if they get that message out there, they're a credible institution.
Right.
They're trying to pump the price of Bitcoin. I mean, there's a long period of time where the top CEOs, like Jamie Dimon, for example, they would say, "Oh yeah, Bitcoin's trash," or Mark Cuban, "Oh, it's trash," and then they're suddenly taking Bitcoin and investing in it, and it's almost as if it was like a concerted effort to make the price go down as much as possible.
Yeah, because they have clout. I mean,
they do,
and they know that if they
works.
talk, bad about a product or something or an asset, that it's going to go down because people are listening to them. That is their, entryway into that, because they've just decreased the price. I mean, granted, that's illegal if you do it very directly, but indirectly they're able to pull it off.
Here's just like a quick little fact before we end it. If an Olympic-sized swimming pool has a volume of 2.5 million liters, and we divide and get our answer, ultimately 3.27 swimming pools hold the entire global supply of gold that has ever been mined on Earth.
Wow.
Yeah, that was a very tangent kind of segue, but I just want to let you know that there's 3.27 swimming pools, Olympic-sized swimming pools, that hold the entire supply of gold ever mined on Earth.
Gold doesn't have a CEO.
It doesn't.
Neither does Bitcoin.
And everybody likes it.
Yeah.
It's interesting. It's like, oh, it's so shiny.
That's a pattern right there.
And
Gold
it's useful.
does not have a CEO. Well, anyway, thanks for listening, folks. Just a quick little shout out. We have a Redbubble store up and running, and we're selling some merch on there.
Yes.
If you like the show, you like hearing what we say, feel free to support us.
And don't act like you don't have the money. You're about to get a $2,000 stimulus check coming in March. We need you to at least get one for your friends, your family, your mom, your dad. Get them to listen to the show. Thank you for listening.
And we're not financial advisors.
You will lose money.
Goodbye.